Hello, my name is Declan Allen and you are very welcome to our video briefing today, which is one of the most hotly discussed topics for all retirees. Do I buy an annuity, otherwise known as a pension, or do I invest my pension fund assets in an approved retirement fund, more commonly known as an ARF? We at Allen Retirement and Finance are experts in this area and will be delighted to help you with this huge and extremely important decision. This video will raise some questions and will give answers to those questions. But to understand your own special circumstances, please get in touch. Well, if you've been building up money in a pension plan, you can use that money to buy an annuity, also known as a pension. This is a guaranteed taxable income for the rest of your life. You may also be able to purchase an approved retirement fund, more commonly known as an ARF, which doesn't provide a guaranteed income, but does allow you more flexibility in drawing down your income. An annuity is a pension where you are paid the same amount every year. This is also known as the standard annuity. However, if you accept a lower income while you're alive, you can also choose for your partner to carry on being paid some or all of the income after you die. The more to be paid after your death, the smaller the initial income you receive. Yes, generally you can take up to 25% of your pension pot as a lump sum. However, any lump sums over 200,000 will be taxable. The amount will depend on which type of pension product you have invested in. You might want to use this to pay off your mortgage, maybe put in a new kitchen, or just head off on that holiday of a lifetime. When you buy an annuity, you hand over your entire pension savings to a life company, and in return you get the promise of an income for the rest of your life. If you die shortly afterwards, the funds die with you. But it is possible to buy a joint life annuity, which pays an income to your spouse after you've died. You can also buy a guaranteed annuity, which pays out for a set period of time, say 5 years, to your beneficiaries if you die within that period. But the more options you build into your annuity, the less pension income you will receive. Yes, it is. Your plan will contain an open market option, which means you can shop around for all providers. This is part of our services at Allen Retirement and Finance. You can take it that the lower interest rates are, the lower the annuity will be. At this point in time, they will be very poor value for money, and if interest rates are to remain low for the foreseeable future, well then there can only be one outcome. This may be a good idea. It's easier and often more cost effective to transfer your pensions into one pot because everything is in the one place. First, check that you are not giving up any valuable benefits such as a guaranteed annuity rate. There may be charges for moving, and there's no guarantee that your investment will be worth more if you move it. Again, we at Allen Retirement and Finance will be happy to assist you. If you have a personal pension, a PRSA, a fund related to additional voluntary contributions, or certain company pension arrangements, you could consider investing in an ARF. An ARF allows you to keep your fund invested and decide how much taxable income you wish to withdraw each year. You must withdraw a minimum of 5% per annum from your ARF fund value from the year you turn 61. To invest in an ARF, you must have a guaranteed minimum pension from either the state or other private pension funds of at least $12,700 a year for life. This cannot include rental or dividend income. If this minimum is not in place, then the first $63,500 of your pension pot must be invested in an approved minimum retirement fund or to be used to purchase an annuity, or a combination of both. An AMRF is a similar kind of investment to an ARF, but it includes a safety net required by the government to make sure that you are provided for in your retirement. You cannot withdraw the capital in an AMRF until age 75, although you can take the investment growth on this fund each year and pay tax accordingly. If you have an ARF and an AMRF and unfortunately pass away, all of the monies left in the fund, including any investment return, are payable to your estate. This is obviously a major consideration and is often the real difference between the decision to buy an annuity or invest in the ARF. We have compiled a table of the advantages and disadvantages of investing in either an annuity or an ARF. Please take the time to study the attached PDF. However, each individual circumstances differ, so we would urge you to give us a call for a personalised review of your situation. Please look out for our other briefings and stay in touch with us. Many thanks and goodbye for now.